Okay, so the CPI report came out for the month of July, and the numbers weren't quite as bad as what I predicted. So what I predicted on my little projection chart table was that I was thinking that the CPI would jump by about 0.9% this month, which would lead to a year-over-year inflation rate by 5.7%. And of course, if you guys haven't seen my previous videos on this, I'll post a link into the description of how I formulate this. I base this calculation off of the final demand goods from the producer price index. That the previous month, final demand inflation tends to funnel into next month's CPI, roughly speaking, but there can always be changes. Anyway, I'll go into more detail tomorrow, and I think I'll save that till tomorrow because the final demand and producer price index numbers are going to come out tomorrow, so I'm definitely going to publish another video on that. But I'll show you what I was doing in my table. My table contains a range of prices in there, and the price inflation year-over-year metrics, and it's essentially a plus or minus 0.5% on the year-over-year metric. So whenever I predict that the number is going to be 5.7, it's really with a plus or minus of 0.5 off of that 5.7. So that year-over-year range could be as low as 5.2 or as high as 6.2. And it's really the only way that I could do that with any kind of high degree of confidence. And I was surprised at how much level of confidence I could get with that little table projection model. It's about 85 to 90% confidence, but I'll go over into more details about that. So let's recap over what's going on in the CPI. So obviously the month-over-month numbers came out at about 0.5%, a little under 0.5%, and the core inflation numbers came out at 0.3%. Wall Street was so happy about this because they were thinking that the numbers would come out at 0.5 and 0.4 for the CPI and the core CPI respectively. And of course, they cheered and crowed because, the numbers weren't 0.9% inflation every single month. That's not going to always happen. You're always going to have months where the inflation rate looks low before it starts to build up again. Okay, so you're going to have your lulls as it will increase. But does this change my outlook on inflation? No, it doesn't. And the reason why is because your commodity prices are still increasing. They're still sky high, and I'll go over that in a couple minutes. And also your money supply numbers are still growing and still going up. So as long as really Fed monetary policy and expansionary fiscal policy are going on, this is not going to change my inflation outlook. Those numbers are going up. We are still having to catch up on inflation right now. And I'm going to show you a few tables that kind of point this out and illustrate it. So let's go over the year-over-years. You can see how the year-over-year core inflation kind of dropped from 4.5 to 4.2, and whereas the CPI largely stayed stagnant. This is because back in the month of July, when you take a look at the month-over-month numbers for both of these indices, the month-over-month numbers for July were quite high. Okay, so if you look at it here for July, they were each above 0.5%. And so when you take a look at what's going on in July of 2021, well, we were still getting an elevated inflation rate of nearly 0.5% for the aggregate CPI and 0.3% for the core CPI. So that's why it brought down those year-over-year numbers. So those base effect things that Jerome Powell likes to cite as to why the inflation numbers were spiking early in the spring can also work in reverse. Base effects is what was causing the inflation numbers to stagnate or even drop a little bit. But in truth, the inflation rate is about flatlining right now, and I do think it's going to pick up steam. Though I think it's going to still increase in the coming months. Although to be technical, the final demand numbers that we're going to get tomorrow will give me at least a much better outlook at what to expect for the CPI inflation monthly numbers that are going to come out for August in the middle of September. And just to give you kind of a frame of reference, just take a look at this final demand. So the red line here is the final demand inflation index, and the blue line is the CPI conformed to that final demand index. And look how close those two numbers run alongside each other. So your final demand goods is your producer price indice for all commodities that is at the very end of the production chain. So they are basically all but finished, and they're about to come out to market to be sold to the customer. And so that's why you see this very, very high, strong correlation between these two index numbers. So last month, what was going on with the final demand good? Well, your final demand goods for last month were coming out with an inflation rate of 0.8%. Okay, so that was one of the justifications that I had for why we were going to get a CPI inflation rate. Actually, your final demand for last month was 1%. That's why I was thinking that your CPI would jump by about 0.9%. Okay, sometimes you get a real big deviation in the final demand numbers. Okay, so take a look at this. Here you had your final demand goods increase by 1.2% in January, and then in the following month in February, your CPI only increased by 0.4. So it's like, well, what caused that huge divide? Well, sometimes a spike in final demand may take longer than 1 month to come out to the consumer markets, but nevertheless, it is going to come out to the consumer markets. So that high jump is coming out. And how do I know this? Well, it's just, you just take a look at the index numbers and how they run alongside each other, okay? So when you take a look at those index numbers and run alongside each other, they run hand in hand. So something's got to happen to that final demand. Either the final demand has got to come down and the producer prices and commodities are overshot on prices and they're going to have to drop, or the CPI is going to have to rise to meet and absorb some of that final demand cost. And we're already getting reports about how certain companies are already planning on raising prices. So Tyson Foods just came out and is saying that they are going to hike prices now in September. So starting September 5th, Tyson is planning on hiking their prices here, okay? So, and the reason why they do this is because they've been having these higher cost of animal feeds that have been going on and higher cost of grains. Again, those are your high commodity prices, and so now they are basically passing that off to the consumer in the coming months. So this inflation number is coming down the line, okay? You know, you can see here that, you know, for instance, pork prices were increased by 39% by Tyson Foods over the last year. These numbers are coming down the line. Just because there's a stagger effect over the summer, because nobody marks up their prices right away, doesn't mean that we're out of the woods here. And so we're not by a long shot. Now take a look at your year-over-year final demand, okay? So red line, again, we're looking at final demand. Blue line, we're looking at your consumer price index. And look how close these lines track with each other. Now sometimes your final demand goods will drop and your CPI won't drop quite as much. Other times they'll rise and the CPI won't rise quite as much, but they still tend to hold. They still tend to run together. They still tend to run together hand in hand. Well, look at what's going on with final demand. Your final demand is over 7.1%, and your CPI is down by is only up by 5.3% year over year. Okay, we haven't had this huge of a divide ever in the history of the CPI and final demand. So again, that reinforces the narrative. If the CPI is going to come down, this final demand goods have got to come down. If they don't come down, that cost is going to be passed off to the consumer price index. We're going to see this at the grocery stores, at the supermarkets, and at the gas stations, okay? Same goes with the producer price index of all commodities. That's really what's driving these higher costs right now, is your high commodity prices. Why are commodity prices being bid up so high? Well, yes, it's a combination of the logistics issues with the supply chain shortages, but it's also that expansionary Fed monetary policy. You can see here in the past when expansionary monetary policy was causing producer prices to start increasing in 2010 and 2011 before the shale fracking boom happened and brought those commodity prices down, which is what kept the CPI in check. Now we're seeing high commodity prices spike again due to the government shutdowns and the recovery from that, but also, yes, due to sky-high Fed monetary policy. And it tends to work that whenever your producer price inflation goes up, the peak, it tends to be about 1/3 of that translates into the CPI, if not at least 30% of that. So based off of that, we've still got a little bit of room to go. It looks like the CPI should be popping off at about 6% year-over-year inflation in the coming months at least. And that's if the producer prices peak right now at 19.5%. My guess is that those numbers are going to continue to go up, and I'll go over into more details when we get those out tomorrow, okay? So, and then lastly, and this is something I want to touch on, is that remember that shelter component of the CPI, okay? So remember now that the shelter component of the CPI contains 1/3 of that CPI. And this shelter component measured in blue of the CPI has been really, really low because of the pandemic shutdowns and the drop in demand. But the combination of eviction moratoriums along with expansionary Fed monetary policy has shot up the home price index, okay? And so I expect these numbers to continue to go up. Right now, as of the end of May, the Case-Shiller home price index is at 16.6%. I've got the numbers charting out to June and July, peaking at around 18 to 19% based off of this trend projections. And that trend is likely to continue, and that's going to start funneling into these shelter price components. And it's going to push up this shelter price component year-over-year inflation well above its pre-COVID. So pre-COVID, year-over-year shelter component was at 3.5% inflation. We're going to go well beyond that, and we're probably going to go even beyond what the shelter component was reaching back in 2007. It looks like we're really going to see year-over-year inflation rates of around 6% for that shelter component, which would translate into a permanent CPI increase of 0.2%. Okay, so when we take a look at this table of the CPI, this 0.5% right now is still pretty horrible. I mean, you annualize this out, this is 6% year-over-year inflation still. So 5.5%, 6% year-over-year inflation. Wall Street's thinking that this is a good thing. No, it's not. This is absolutely horrible. Just because it wasn't as horrible as what the June numbers were showing doesn't mean anything. I mean, annualized, the inflation rate for 2021 using the CPI is still 7%. 7% inflation is god-awful with the levels of debt that we have. Wages are not going up by 7%. Wait until wages have to be marked up to try to match for this demanded by the workers. That's just going to push price inflation up even further. Push up even further as workers seek relief from this. So we're not even seeing that. Your food prices went up by 0.7% this month. Your energy prices went up by another 1.6% this month. And, the only thing that was keeping things in check was your core inflation, because your core inflation came out at 0.3%. That's what everybody's war whooping about. But really, when you take a look at the components, nothing really is dropping. I mean, motor vehicle insurance dropped a little bit for whatever reason, I don't know. Transportation services dropped a little bit, but everything else is pushing above. And if you take a look at the components, most of them are well above that 0.3% area. They're at least 0.4% higher. So this CPI annualized inflation rate is going to be at least 5%, if not 6%, and it's looking that way at the end of the year. So nothing has really changed in all of this. But once again though, when the final demand numbers for producer prices come out, that's going to give us a little bit more line of sight of what to expect in September. So if you caught these numbers and you're thinking that this is bullish for Wall Street, it is going to be bullish for stocks because they're expecting that this is going to continue to taper down. This sort of feeds into that Fed narrative, but there really is no other appending data feeding into the Fed narrative that we're seeing a tapering down of inflation. If anything, what we're seeing is more of just a return from really high month-over-month price increases in June. Because if you take a look at February's, what was February's increase in the monthly inflation? Why 0.4%? What was March's? 0.6. What was April's? 0.8. What was May's? Back down to 0.6. What was June's? 0.9. So everybody's happy that it was only 0.5%? Shoot, that's nothing. We used to have monthly inflation rates of 0.1 to 0.2%. I mean, what happened to that when we were happy that we got 0.1 to 0.2%? We're happy now that we're seeing 0.5%? That's nothing. Just because you have a 1-month downtrend doesn't mean anything. But if you want a rule of thumb of when to know that a trend is confirming, I usually use the 3 times the charm as rule, okay? So 1 time statistic is an anomaly. Twice is a coincidence, but 3 times is a trend. So if we get 3 months of falling inflation rates, only then will I say that we're probably going to be on a containment route where, yes, it looks like those inflation numbers are going to come down and they could regulate below the levels that I've been saying. But based off the money supply numbers, based off those commodity prices, based off the rising home prices, that really does not look like to be the case right now. Certainly, I don't think these numbers really bolstered that case anything. If anything, they just gave it a little bit of a lull to try to feed into that narrative. But once again, I'll wait until the final demand numbers come out tomorrow before I start passing true judgment on what to expect for September. And I'll let you know and relay that data to you tomorrow evening. So be on the lookout for that video. That's really going to give us a lot of details and probably would give us some insight if we are going to be on a downward trend to inflation. So my own personal views on this is that I think the inflation numbers are going to go up, but I'll definitely give those statistics out to you and tell you if that sentiment starts to change or if I start seeing any kind of evidence that we may be seeing that change in the inflation rates. Guys, thank you for watching this video. If you like the content, make sure you click that like button, show me some support, comment on the video, let me know what you think about this, whether you agree or disagree. Hit that subscribe button, click that notification bell so that way you're notified whenever I update. And tomorrow evening, I will talk to you then.